Up, and away. Whether it's stocks or high-yield bonds or Bitcoin, investors are having a tough time finding assets they don't want to buy. This is Bloomberg Wall Street Week. I'm David Westin. This week, contributors Larry Summers of Harvard and Afsaneh Beschloss of RockCreek.
There are many new players in the equity markets as the power of the retail investor has become also very different.
General Motors CEO Mary Barra. Wes Moore of the Robinhood Foundation, former SEC Chairman Harvey Pitt, and Steve Rattner of Willett Advisors.
A certain number of Bitcoins have been mined, and there will never be more Bitcoins. I don't completely buy the whole thing.
Trees may not grow to the sky, but don't tell the stock market that. Not when its trees are being watered by a Fed promising to keep free money flowing.
Achieving and sustaining maximum employment will require more than supportive monetary policy.
Not when the Biden administration is intent on feeding another $2 trillion into the economy.
I think we're in a position to think big and move big. I know I've found some common ground with some of my Republican friends.
And not when there's the promise of vaccine on the horizon. But are we moving too far and too fast? Some warn about the risk of inflation, but Fed Chair Jay Powell downplays that possibility.
You know, in major part, we are looking at actual inflation. We want to see actual inflation.
Equity markets continue to move higher this week for the most part, pushing up against records, blowing hot and cold on the reflation trade, and leaving bond yields to stay range-bound, even as high-yield spreads set new record lows. And to take us through a week when the markets just seem to go up and up, we welcome now a roundtable of Afsaneh Beschloss. She is the CEO of RockCreek, and Steve Rattner. He is the chairman of Willett Advisors. They invest the personal and philanthropic assets of Michael R. Bloomberg. He, of course, is the founder and principal shareholder of Bloomberg LP. So welcome to both of you. Afsaneh, let me start with you. As I said, it looks like right now the equity markets, by and large, just go up. How do you invest into that market as a practical matter? Because it looks like we're investing almost in the government, in fiscal and monetary policy, and some vaccine, not in the companies themselves.
You're absolutely right, David. It has been seeming like that, but there are many new players in the equity markets, as we've seen also in the last several months, in the last year, as the power of the retail investor has become also very different. The interesting thing that is going on with the institutions, though, is that as they saw last year, some of them were sitting a little bit on the side of the market, and they're seeing that momentum is very important. And that's why you're seeing not just the retail, but big institutions also keeping additions to their equities. The only thing I would say, David, though, is I think actually stock picking is coming back, and it's not just going to be the index funds that will matter. In fact, if anything, it will be much more important to choose stocks, even though you have this kind of momentum, because you could also get killed if you're in, let's say, oil stocks versus renewables.
So, Steve, you have a lot of money that you have to put to work. Do you agree with that, or is Warren Buffett right that basically for most investors, you should just be betting the market?
Well, I actually probably agree a little bit more with Warren Buffett as far as individual investors are concerned, but let me just go back and agree with what Afsaneh just said and add a little bit of how we think about it. First, I think when you talk about what the government's doing and the stimulus and all that, I think what's really put a floor under this market are interest rates. And as when the S&P dividend yield is higher than the interest rate on the 10-year, it's easy for people to say, well, why wouldn't I just take the S&P dividend plus hopefully some appreciation and so forth? And so when we think about the market, one of the things we keep an eye on is whether interest rates are going to start to rise. High interest rates are the enemy of the market. In terms of the valuations and it going up and up, interestingly, corporate profits have held up surprisingly well during this period. And in fact, in this current earnings season that we're right in the middle of now, something like 70 or even 75% of companies are beating expectations. And so there are real earnings coming through for many of these companies. And the third thing I'd say is that as we talk to our managers, and most of our money, as you know, is managed by specific specialized funds that have a specific area of interest, we have rarely seen so much enthusiasm, bullishness, if you want to call it that, about the market. In addition to what I said about interest rates and so forth, and earnings coming through, what our managers are seeing is this $1.6 trillion of pent-up demand, of excess savings, of dry powder, whatever you want to call it, that Jason Furman and Larry Summers has talked about this a bit as well, that many of us expect to become unleashed as the virus becomes less of a fact. People get vaccinated and start to go out and have all the things to do that they didn't get to do and now want to do, and the cash to do it.
So, Afsaneh, pushed together two things that Steve just talked about. One is Larry Summers and Jason Furman. Also, I'll add Olivia Blanchard, warning actually about the possibility of inflation coming back as we keep pumping money into the economy, and the interest rates being the enemy of the market. Is there a risk as an investor? Do you need to take that into account? A risk that inflation may drive up interest rates and change the complexion of the market?
Absolutely. That is something that we watch very very closely. As you know, actual reported inflation at the moment is incredibly subdued. There was just a number the other day, and there's really no sign of anything. But that's not surprising. We're still in this kind of partial lockdown. But when you look ahead at inflationary expectations using treasuries and tips and all the calculations you can do, inflationary expectations have moved up a bit. They are now in the 2% range when you go out 1 year. And that's fine because that's the target. But it is something we absolutely keep a close eye on.
Afsaneh, what about RockCreek?
It's really interesting because both Fed chairman and the European Central Bank are basically saying I don't want to say they don't care about inflation rates, but they're not concerned. They're not going to be moving to do anything different than what they've been doing. So that, I think, is very indicative of what's going on. In terms of, we also look at Japan as a really important sort of historical fact, how hard it has been to push up inflation. Obviously, the kind of numbers in terms of our stimulus plan that we're talking about right now, plus what we will be talking about very soon, hopefully, which is on the infrastructure front, will be very important in terms of pushing inflation, maybe in some areas. But let's not forget, it's also the fact that inflation itself, the way we measure it, everyone knows, is problematic.
Steve, Afsaneh mentioned infrastructure, and that takes us to what President Biden calls his Build Back Better. That's not what we're talking about with the $1.9 trillion. That's something next. Is there going to be room, fiscal room, to be able to do that? And that takes us back to what you said. A lot of people are very bullish on the market. Are they bullish on the economy, Steve?
In terms of the question of infrastructure and fiscal space, and obviously everything that Larry's been talking about, first, I would associate myself completely with everything he's been talking about. And since they're his thoughts and he says them well, I won't repeat them all. But in terms of fiscal space, yeah, we do have essentially unlimited fiscal space. I don't think there's any real danger that the credit markets are going to throw up at us and say, we're not going to lend you money anymore. The question is, what is it prudent to do? These deficits, in my view anyway, really are an intergenerational transfer.
Briefly, Afsaneh, Steve identifies himself with what Larry Summers has said. I'm not sure you do.
You know, I agree with lots of things that Larry says, but I think on this back and forth in the last week or so, I would be in a different camp. I do feel like we should be really concentrating on the third of the population that is hurting. And instead of worrying as much about targeting to the decimal point, start thinking about how we get that part of the population up to a very different level. So we can say that, you know, for example, how much is going to reopening schools or education is too much. But we know how far back our education has fallen just in the last year. The needs are much bigger, I think, than people realize. And I think if we could, as economists, start concentrating on the bottom half versus getting distracted on the minutia on the targeting, we would get the economy to a better place, because those people will have a higher demand and will spend more. And so that also takes me to sort of this whole argument about the $15 wage. Somebody will have to pay for people to have a certain minimum level of living. So it's either the government or whoever's paying their wages.
Our roundtable of Steve Rattner and Afsaneh Beschloss will be staying with us as we turn to yet another asset that just keeps going up. That's Bitcoin. We're going to talk about what that cryptocurrency really is. This is Wall Street Week on Bloomberg. GameStop's dizzying rallies and slumps have good company in Bitcoin. The cryptocurrency's rally got new life this week after Tesla CEO Elon Musk announced that the electric vehicle maker invested $1.5 billion in Bitcoin and signaled its intent to begin accepting it as a form of payment. But even Elon Musk couldn't save the cryptocurrency from its volatility.
Cryptocurrencies are a good example where you see the same type of price action, where it's not clear these are justified by any value argument and any fundamental arguments.
Bitcoin quadrupled in price in late 2020 after gaining some mainstream momentum. PayPal started allowing consumers to buy, sell, and hold cryptocurrencies in their PayPal wallets, and Fidelity launched its Bitcoin Fund. Millennials also jumped on the Bitcoin bandwagon by using stimulus checks to buy the cryptocurrency.
The concept of retail backing stock for it to go up and up and up. Bitcoin and Tesla are clear examples.
Bitcoin is also getting institutional interest. A Fidelity investment survey found that 36% of institutional respondents held crypto in their portfolios. More than 6 out of 10 expressed interest in Bitcoin and other cryptocurrencies, up from fewer than half in 2019.
I originally thought Bitcoin would end the year at 50 or 60,000. Things are happening so much faster than I had predicted. So now I think Bitcoin could end the year at $100,000.
Most of Wall Street is still sitting on the sidelines. JP Morgan is the farthest along in its Bitcoin acceptance. Last year, it agreed to take on Bitcoin exchanges Coinbase and Gemini Trust as banking clients.
I don't think the investor base is big enough and deep enough right now to support this kind of valuation.
There are regulatory hurdles that stand in the way of Bitcoin going mainstream. The U.S. Treasury Department has proposed requiring banks and other intermediaries to maintain records to verify customer identities for certain cryptocurrency transactions. Recording transactions would go against the very principle of Bitcoin, which promotes anonymity.
Those folks who have really dug in on this asset class know that using assets like Bitcoin for anything the least bit nefarious, illicit, etc., is probably the worst mechanism possible, since every single transaction leaves a digital breadcrumb.
And to help us understand what Bitcoin is and where it is going, we welcome back now our roundtable of Steve Rattner of Willett Advisors and Afsaneh Beschloss of RockCreek. So Steve, let me start with the most basic question I genuinely have, which is, what is Bitcoin? I sort of understand blockchain a little bit and know that it's made up, but what is it as an asset?
Well, that's a good question, and maybe I'm not exactly the right person to ask because I'm on the more skeptical side of the ledger on this. But essentially, it is a currency that was created, and the theory behind it is a certain number of Bitcoins have been mined, and there will never be more Bitcoins, and therefore you can have some confidence in the value of it because there's a limited amount of these things, and they therefore will retain their value. And if I'm sounding a little bit halting, it's because I don't completely buy the whole thing. You're essentially saying that we're going to create a store of value and a medium of exchange around something that only exists inside of a computer somewhere. It's not a physical asset. And so you look even at gold, and gold is a physical asset. Gold has other uses besides simply people investing in it. We put it in jewelry, we put it in dentistry and so forth. And it has been a store of value for 5,000 years, and people have accepted it as a store of value. So the idea that Bitcoin is some kind of store of value, to me, it kind of feels a little bit like wampum. What's the difference between Bitcoin and wampum, which was a store of value in Native American times? So I'm a little bit on the skeptical side of it, but it is intended to be by those who believe, including very, very smart people like Elon Musk, as a medium of exchange and a store of value. And they are moving very fast in that direction. And we're going to find out sooner or later whether that actually works or not.
So, Afsaneh, is there any ready analogy? I mean, is it like a commodity? Some people say it's like a commodity. Is it like a currency? Is it like a security? What is it?
You know, it has behaved a little bit like gold, particularly in the last probably 12, 18 months. But what has also been interesting, I think as Steve was saying, it has a limited size right now. What is it, about 900 billion or so that has been issued? And so when we talk about the 1.5 billion that Elon Musk bought and put sort of on the cash books of Tesla, it's not that much. I was really surprised that he put it on the cash side because it is so volatile and so much more volatile than gold has been So if you are going to include it in a portfolio, and I think, the jury's still out as to whether it will or will not have staying power, as Steve was saying, but let's assume that you think there is some staying power. With something that is that volatile, would you put it in your cash portfolio, or would it be like a pretty high risk, high volatility part of your opportunistic portfolio?
Afsaneh is absolutely right. What we are hearing and seeing among people who do what we do, managing really large pools of capital in a diversified way on behalf of wealthy individuals or charitable causes, they are actually moving to do this. They are actually allocating 1%, 2%, some relatively small amount of their portfolio to Bitcoin as an inflation hedge. They see it in the same role that commodities have played, although I don't think it's a commodity, David, because the quantities are so limited. The same role that commodities or gold or things like that have played historically. Institutions are actually now doing this. They're putting it in their portfolios thinking it's a good inflation hedge.
Would you put it in your portfolio, Steve?
Until someone convinces me that there's some real reason to believe that it is a store of value and an inflation hedge, both, but at least a store of value that will be accepted over the next 10, 20, 30, 40 years, I think we're going to hold off until I get some conviction around that, which I do not yet have.
Afsaneh, what about RockCreek?
We're looking at things like custody rules and seeing how sort of the new regulators will start looking at Bitcoins, which is still not clear. But at least we know that with Gary Gensler and others coming in, they have a lot of knowledge of how the financial system is changing with these new tools, and we'll look at this carefully. So for us, I think we will start looking at it a little bit more seriously, a little bit less skeptic than Steve is, and we can compare notes in a little bit.
Okay, thank you so much to our roundtable of Steve Rattner of Willett Advisors and Afsaneh Beschloss of RockCreek. Coming up, regulating Robinhood and those pesky Reddit day traders with Harvey Pitt, former SEC chairman.
The real difficulty is these hearings are premature, and it's not clear that anyone fully understands what the problems are.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. This week, GameStop stock continued to drift back toward earth. But next week, Congress will take up the question of what happened and whether regulators should do something about it. Harvey Pitt, former chairman of the SEC, thinks he knows the answer.
I think we're going to hear a lot of concerns expressed over what took place. And that's only natural, but the real difficulty is these hearings are premature. The SEC has wisely said that it is going to do a thorough review of everything that occurred. And it seems to me before you can fix any problems, you need to know what the problems are. And it's not clear that anyone fully understands what the problems are. All people have seen are a number of incidents connected to some very volatile trading, but that is just what the appearances are, and one has to think about what the proper role of government is in dealing with these kinds of situations.
Is this a different investigation than perhaps when you were there, in the sense that an awful lot seems to be cyber? That in fact there'll have to be forensic unpacking of some of the tweets and the communications, for example, on Reddit by social media. Is that a different sort of investigation?
It is in this respect. The SEC will have to find out who did the postings and what the motivations were behind those postings. The fact that people express themselves favorably about a stock is not itself a criminal activity. But if hypothetically there were people who were acting in concert to try to manipulate the price of the stock artificially, then that could very readily give rise to potential civil and criminal liabilities. That means the SEC has to go behind the postings, learn who made those postings, learn why they made the postings, and also look at any correlative trading activity that those individuals may have engaged in.
Is it also something that should be at least on the agenda to look at the very structure, the business model, as it were, of a Robinhood? As I understand it, they're a registered broker-dealer, but they have a business model based on what I understand is pay for flow. That is to say, they can do this without charging the people who are actually doing the trading. Is that something we should be taking a look at?
I think it is something that the SEC needs to take a look at. Payment for order flow has been an issue that has been around for a very long time. It raises some serious concerns. If in fact the benefits of paying for order flow are funneled back to the traders, the investors themselves, then it can be a very legitimate methodology. But one of the questions that has to be asked is why people are paying for order flow and whether there needs to be much more disclosure and perhaps even regulation surrounding that practice.
That was Harvey Pitt, founder of Colorama Partners. And it's time now for a look ahead on Global Wall Street.
David, next week it's the start of trading in the year of the ox. So we'll see Asian markets reopen after the Lunar New Year holiday break. China, it will be the chief among them, coming back online on Thursday. Now, the recovery we're seeing from the virus in this part of the world will certainly be another focus. We've got GDP data due in Japan, Thailand and Singapore. Singapore will also present its annual budget on Tuesday. We may see a narrower deficit target for 2021. Over in Australia, jobs numbers will be a watch there. We are expecting the unemployment rate to edge down on Thursday. As for earnings, Aussie mining companies will be in the spotlight, particularly BHP and Rio, and the demand that they're seeing from China. Danny?
Thanks, Annabelle. Over the next week, the vaccine progress in Europe is going to be closely scrutinized. Euro area finance ministers are going to be meeting with the WHO to discuss their rollout versus the rest of the world. And they also want to come to agreement on a coordinated fiscal response. We'll also get clues about how the economy is doing between ECB minutes and PMIs due out later in the week. Scarlett?
Thanks, Danny. In the upcoming holiday-shortened week, there'll be plenty of economic tea leaves to read. The Fed releases minutes from its first policy meeting of the year, and we get a snapshot of retail sales in January. We'll also be pouring through 13F filings to see what the biggest money managers have been buying or selling last quarter, which will be all the more fascinating as Congress begins a hearing on the GameStop frenzy, as former SEC Chairman Harvey Pitt just discussed. Now, on the earnings front, Walmart will kick off the reporting season for retailers, while Royal Caribbean and Norwegian Cruise Lines also announced their results. David, back over to you.
Thanks to Annabelle, Danny, and Scarlett. Coming up, the pandemic reaches its one-year anniversary. We review what it's done to us and what long-term effects it will have with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg.
Experience suggests that major pandemic events are events that take place somewhere between once every half century and once every century. The fact that this one has gone so far has to mean there's a substantial chance that it's the one for this half century or this century. And the events that take place that infrequently, the worst of them, kill a number of millions of people, and quite possibly as many as 10 million people.
That was special Wall Street Week contributor Larry Summers all the way back February 6th of 2020, a year ago now. And this was before, of course, there was a total shutdown in the American economy, and it became rampant across the entire country. We welcome now Larry Summers back. And Larry, I know you don't want to take a victory lap. This is not good news. This is sad news, but you were right. You said millions could die, millions have died, could be as many as 10 million. We're a quarter of our way there globally right now. Give us a sense of what you think COVID-19 has done to this country and to the world so far.
God, I wish I had been wrong. I think it's so far probably the most significant event of the 21st century. I think we're getting towards the end of it in its acute phase, at least in the industrial world, but it's going to cast a big shadow forward. And I think the ultimate historical significance here is going to be that Asia basically managed this successfully, and the West basically managed this unsuccessfully. Beyond that, David, I think it's accelerated the trends that were either concerning us or exciting us before it happened. We're all going to be working with much more IT in our lives much sooner than we envisioned. Most of us thought of Zoom as having to do with how fast you were going a year and a half ago. That's not the first association any of us have with the word Zoom today. It's going to change how we work. It has been, like so many things, much more painful for those with less education and for those in the lower part of the income distribution than for those who are fortunate. I think it's also going to change geography. I was very worried for a variety of reasons about the prospects for New York City. I am much more concerned today after the catalyst to exit that COVID represented. So I suspect that when people write histories of the 21st century, whether those are geopolitical histories, whether those are economic histories, whether those are social histories of how people live, there's a real chance that this will be remembered as a hinge point.
With respect to the comparison between the United States and Asia, particularly China, let me take that. Before the pandemic happened, there was an economic race on, and China was clearly catching up, was going to surpass at some point. Does this permanently change the shape of that race? I mean, I guess I'm asking, can we catch back up?
Look, I think it is right for us to be very focused and very concerned about our competition with China in economics and in technology. But it is wrong to make absolute statements. The predictions in, for example, my uncle Paul Samuelson's textbook in 1960, that Russia would overtake the United States by 1980, look foolish in retrospect. Much of what was said in the late 80s and early 90s about the emerging Japanese power looks foolish in retrospect. So can the United States still be an economic superpower? Will we be able to compete with China? Yes. Are the magnitude of the challenges our system faces greater today than they were a decade ago? Absolutely. Are they greater than we expected they would be a decade ago? Absolutely. Do they require us to innovate in technology, innovate in education, innovate in infrastructure? Look, that's part of why I'm so concerned about a budget strategy that's mostly based around writing checks to people. That is not building our capacity to compete with China.
Well, let's talk about building that capacity in an area you know terribly well. You just mentioned it, education. Clearly education, whether it's higher education or grade school education, has really been hit hard by this pandemic. It has not recovered, far from it so far. How do you assess the loss that we're taking right now in educating our young people?
Look, as best we can tell, when you lose a year of education early in life, you get some of it back, but you don't get all of it back. And so the scar that is being placed on millions of children who really didn't get much schooling this year is not a scar that's ever completely going to heal. The president is absolutely right about the importance of getting people back to school safely. That is about vaccinating, that is about testing, that is about having appropriate infrastructures. And I yield to no one in the importance I attach to doing this safely. But I have to say that entrenched, and I'll say it, teacher union interests that have resisted going back to school have really been putting their own material benefit ahead of the interests of their kids. And that is not the best tradition of the teaching profession. Some cases, they're absolutely right to be focused on what's necessary before we move forward. But I'd sure like to see a much more collaborative spirit between teachers and school districts to get people back to school. I think the success we've had in higher education, David, in some ways, my class this year by Zoom was better than it had been with me in person because there was editing. There was the opportunity to bring in people from all over the world to speak to my class. I think America needs to launch a major initiative to bring what's in our universities, which is one of our great sources of national strength, to the entire world. And I hope that will be a continuing legacy for President Biden.
So Larry, let me wrap this up by trying to find a happy note. When I practiced law, we had this saying, when you're writing a difficult brief, if you can't fix it, then feature it. Is there a way to feature some of the difficulties we've had? And that is to say, to recognize the fact there has been a failure of competency, as you've talked about repeatedly, on the part of our government, failure in various aspects, and to be something of a wake-up call, a clarion wake-up call that actually could help us turn around some things that, let's be honest, needed to be turned around long before the pandemic.
I think we've got some examples. Look, what we've done with vaccines in terms of producing them and developing this fast is a miraculous tribute to the combination of science, intellectual leadership, and powerful companies and markets. And that gives us something to build on. I think we've had a wake-up call that you need civil, expert, serious, thoughtful people leading a society rather than what we had before. And while I've got some disagreements on nuances of economic policy with President Biden's team, isn't it remarkable that we're talking about the optimal size of stimulus packages rather than talking about possible impeachable offenses by the president?
And there you have the positive note. Thank you so much to special Wall Street Week contributor Larry Summers of Harvard. Coming up, the move from combustion engines to electric vehicles. It's coming faster than we think. And GM CEO Mary Barra is investing $27 billion to get us there.
We're accelerating our EVs with 30 by 2025.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. The pressure is on for automakers to go green. Investors, consumers, and even the new administration are pushing the electric car revolution forward, and Detroit is taking the hint. Ford announced that it will invest $22 billion in EVs through 2025, doubling its previous spending commitment.
You know, we're seeing in both Europe and China, there's a clear race for leadership there in the EV space.
GM's plans to go electric are even more ambitious. The 112-year-old automaker plans to go all electric by 2035 and will spend $27 billion on electric and autonomous cars by 2025.
General Motors is our pick with an $80 price target, $120 bull case. I think it's the one to own this year.
Tesla has already overtaken traditional automakers like GM and Ford with its $772 billion market cap. But not all EV companies have the track record to support their recent surge. Blink Charging, which owns and operates charging stations, is up 2,200% over the past year, making Tesla's 420% stock rally look small. Blink has never posted an annual profit in its 11-year history.
The fact that the market seems to put such a high valuation on EV business, I look upon that as good news, as an inspiration in our journey.
EVs still have a long way to go before they replace gas-powered cars. According to the International Energy Agency, EVs make up just 3% of total cars sold globally in 2020.
There are 280 million cars in the United States, and about 279 million of them run on gasoline, and I don't think people are going to throw away their cars. So I think this is a longer evolution.
But GM CEO Mary Barra is determined to bring the EV future to us faster than we might think. And she thinks it's not just good for the environment, it's also good for her business.
We think we're going to have a very positive year in 2021, not only from a financial perspective, but also the continued acceleration of our EV and our AV business. We're really excited that very shortly we're going to be launching the Chevrolet Bolt EUV, which is a great vehicle, and that's days away. And then, later this year, we'll be serving the market with the GMC Hummer EV, and then the Cadillac Lyriq comes shortly after that, as well as tremendous progress being made from an autonomous perspective as well. So we're really excited about the year, the growth opportunities that we have in front of us. And so it's a year of execution, and the issues with chips, this is a short-term issue, and we'll work through it.
Mary, as you said, you've got a lot of EV models coming out, including, as you say, the Bolt EUV and the Bolt EV new model coming out. You're investing $27 billion. This is part of a multi-year plan here. As a practical matter, what are the difficulties in that plan? And particularly, I want to talk about supply chains, things like battery cells, some of the lithium issues. Do you anticipate possible problems with supply chains into your battery operation?
Well, I think, we're one of only two automakers that are doing cell manufacture in this country. We also are doing a tremendous amount of development on our own and our own GM R&D, as well as partnering with startups and, of course, our joint venture with LG Chem that is development as well as production. So, we're working hard to make sure we have all the cells we need, and we've worked, through the supply base to make sure we do, because we are, as we've talked about, we're accelerating our EVs with 30 by 2025, and really covering the whole market. So we continue to work it, but we think we've got a very strong plan.
I did some rough math here. It might be wrong, but basically, if you made all of your vehicles as electric vehicles, you would actually be using more than the total amount of lithium produced in the entire world by yourself. So does that mean we'll have less lithium used, or are we going to find new sources of it?
Well, I think, we're working on securing the supply that we need, but we're also working on development that allows us to use less precious metals overall. So it's kind of a yes and. Both are things that we're working on.
How much help do you anticipate getting out of the government? We have a new president now, President Biden, who says he really wants to go to emission-free vehicles in the government fleet very quickly. He says he basically wants to replace them all over a period of time, create 1 million new jobs. Is that going to help a lot your move at General Motors over to electric vehicles?
Well, I absolutely think so. I think understanding EVs, understanding the importance, and really we have to work together. Business and governments need to work together to make sure we have a whole ecosystem that encourages EV adoption. We need to make sure there's the right charging, and that's why the work going on for infrastructure is so important. So we're having regular conversations with members of the administration as well as members of Congress to make sure they understand all the pieces that need to come together to support an all-EV future.
That was GM Chairman and CEO Mary Barra. Coming up, what the pandemic has meant for the least fortunate among us, and why taking care of them isn't just right, it's a good investment. From Robin Hood Foundation CEO Wes Moore.
There are still nuances to the policies that are going to have a much bigger and much larger impact if we can actually focus on helping those who are the most vulnerable.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. The pandemic has hit the most vulnerable among us the hardest, and that's particularly true of people of color, and even more so, children of color. Wes Moore has spent his career addressing the needs of those who need it the most. Under his leadership, the Robin Hood Foundation has become one of the leading organizations in the country fighting poverty, because it's right, but also because it's good for our economy. He's been on the front lines of fighting the effects of COVID-19.
The pandemic has had absolutely devastating impacts on communities. And really where you see it is it's on the communities where it was the most predictable that it was going to have a devastating impact. It was the low-income communities where there's concentrated poverty. It was on communities of color. Also because when you consider the fact that how many jobs were lost, many of those jobs that were lost, and particularly the ones that have not managed to come back, these were oftentimes the jobs in hospitality. They were the restaurant workers. They were the hotel workers, the ones who were oftentimes the low-wage entry-level jobs, but they were also the jobs that were keeping families overflowed. And so this has been a really complicated time for families in New York and also around the country.
So taking that need that you know so well and have identified, put it against what we're now talking about with this $1.9 trillion package, because there's a lot of talk about whether it's targeted or not. Is it targeted? Is the money, if it was adopted tomorrow, would it get to the people who need it the most?
It is targeted, yet not enough. And really what I mean by that as well is there are still nuances to the policies that are going to have a much bigger and much larger impact if we can actually focus on helping those who are the most vulnerable. One perfect example is I think about the child tax credit, where, you know, in 2018, and this was before COVID-19, about 12 million American children lived in poverty, right? And child poverty nationwide, the costs are between $800 billion and $1.1 trillion. Again, we can't pretend that there is no cost to child poverty. The cost every year for child poverty is between $800 billion and $1.1 trillion. What we're looking right now with adjustments to the child tax credit is that if you look at the 2017 Tax Cuts and Jobs Act, it had a child tax credit provision, but it included an income phase-in that really prevented over 50% of Black and Latino children from receiving the full benefit. So there are currently 24 million children in this country right now who are too deep into poverty to be able to receive the credit because of this income phase-in. And so when we're talking about the bill that's being proposed right now, the thing that could have the greatest impact on our population, the greatest impact on child poverty, is if you can actually make the child poverty tax credit fully refundable. And also, in addition to make it fully refundable, you then make it permanent. By doing those two pieces to this bill, you would cut child poverty in half overnight.
So Wes, we have to spend a minute or two on you, because you just recently announced you'd be stepping down in May, I believe, as CEO of Robin Hood Foundation. Give us a sense of what you feel you've accomplished there and what has yet to be done.
Well, I am so incredibly proud of the work we've been able to get done as a team and as a community, really, for the past 4 years. I mean, in the past 4 years alone, we've raised $655 million as an organization towards the poverty fight, including $230 million last year alone amid the pandemic, which is one of the highest fundraising totals in the organization's history.
As you look to leave Robin Hood and New York City, at least for the time being, give us your thoughts about what New York City needs to do to get back up on its feet. We have a lot of people who are not in the office, and that hurts a lot of small businesses, frankly, who service those people. Hurts a lot of people with very low incomes. What do we need to do? What would your prescription be for New York City going forward?
Well, I think the first thing that I think people need to remember about New York is don't bet against New York. You know, we've had this before. New York has had this situation where right after the horrors and the devastation of 9/11, people questioned whether or not New York could recover. Right after the financial crisis in 2008, there was so many questions about could New York actually rebuild after the type of economic devastation that it saw. After Hurricane Sandy, people questioned whether or not downtown could even be rebuilt because you had huge sections of the city that were literally underwater. And I think if there's anything that all of those instances and more have taught people is that you don't bet against New York because you don't bet against New Yorkers. But I think the thing that New York really has to do and center and focus on is dealing with a few core crucial issues. And I think this next leadership phase of New York, and whether they have the mayor's race, the comptroller race, the city council race is going to be important. It's about how do you focus on housing and jobs and education. You have to get those things right for New Yorkers.
That was Wes Moore, CEO of the Robin Hood Foundation. Finally, one more thought. When does irrational exuberance become rational? Exuberance was breaking out all over the market this week, but it's not always the fundamentals that are making money for people. The GameStop Reddit phenomenon moved on to cannabis as Tilray was up over 200% so far in the month of February with the Reddit wind at its back.
I try not to pay attention to the daily volatility and focus on the long-term opportunities.
And Bitcoin, don't get me even started about Bitcoin. And if we're talking fundamentals, what exactly are fundamentals for a made-up cryptocurrency?
It also is the embodiment of what we see in frothy markets.
And then we come to Tom Brady and the Tampa Bay Buccaneers. We started the week with the greatest of all time proving it by winning his 7th Super Bowl and being named its most valuable player for the 5th time. When it comes to Brady and the Buccaneers, you have to say the fundamentals are there. An ageless quarterback whose arm seems to be as strong as ever. So you'd have to say that Tampa Bay exuberance was far from irrational. But then, by midweek, even Brady seemed to get carried away as he rode his $2 million yacht in the celebratory parade and then gasp threw the Vince Lombardi trophy from his boat over the water to his Bucs tight end Cameron Brate in the boat behind him. Not surprisingly, Brate made the catch on top of his 3 receptions in the Super Bowl itself. And if the trophy had gone to the bottom, Brady does have 6 more at home after all. But still, in this odd time of exuberance in the face of a pandemic, you have to wonder whether this you only live once trade may be going just a bit too far. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.